Describe credit risk and its components, probability of default and loss given default. Well, let's begin with defining credit risk. This is the risk of loss due to default. And credit risk can arise due to issuer-specific factors or just to general economic conditions. Default means the failure to meet the debt obligations. And in assessing credit risk, we can take a top-down approach or a bottom-up approach. Usually it is a top-down and a bottom-up approach. They all start with the letter C. Typically with the bottom-up approach, we call these the 5 C's of credit. Well, with the top-down, I guess the author wanted to continue on with the C's, so here we are, the 8 C's of credit. The country, any geopolitical risk that happens to be present, and the legal and political framework within that country. Some countries don't really follow the rule of law or have weak property rights. Conditions refer to macroeconomic conditions and currency, domestic versus foreign. Let's say country A issues a bond and issues it in US dollars and not in the currency of country A. So it issues it in a foreign currency. Higher risk associated with that because country A cannot just print US dollars. Bottom-up analysis breaks down into quantitative and qualitative factors. For quantitative factors, we can calculate some ratios. Capacity ratios, which measure the issuer's ability to service their debt. And we can look at levels of capital, here levels of leverage, the amount of equity at play. Then we have character, covenants, and collateral under qualitative assessment. Character is the quality of management. Covenants deal with the legal terms of the debt agreement, what is there to protect bondholders. And collateral, looking at the quality and the value of the assets backing the debt. Let's look at some sources of credit risk. To determine what our sources of credit risk is, we should have an idea of where the cash flows come from to service the debt, the primary and the secondary sources, because the risk of credit will be related to the cash flows, the risk of the cash flows that are used to service the debt. So borrower type, we have a corporate borrower type. Cash flows from operations and from investment and financing activities. Business operations is just cash flow from operations, basically what the company is set up to do. When we talk about investment, companies borrow money to invest in specific projects, and those projects have an incremental stream of cash flows. And financing activities, you can always issue more equity. That is part of a financing activity. Secondary sources of cash flow generation, asset sales, divestitures, that's not just selling assets, but selling a part of the company itself, additional debt issuance, and equity issuance. So, looking at the sources of credit risk and economic contraction, that will decrease cash flow from operations. Strategic shifts in the business and the market environment, again, will be a threat to cash flow from operations. Increased competition, reduced pricing power, same thing. Shrinking operating margins, increased losses, and excessive debt service needs that would put into question the ability to raise additional debt. Looking at sovereign or public entities, mostly taxes and fees. So the first bullet point is all taxes: corporate and personal income taxes, sales taxes, value-added tax revenue, capital gains and wealth-based taxes. And on the fee side, tariffs, fees, and other government revenue. And this could include income from state-owned corporations, whether it be state-owned oil companies. Well, they produce revenues and income, and that could be part of the cash flow to service government debt. Secondary sources of cash flow generation, newly issued debt, and sometimes sale of public assets or the privatization of existing government assets. So perhaps the government owns a toll road and decides to privatize that toll road, can sell it to a private company and monetize that asset to pay down debt. Sources of credit risk, economic contraction. In an economic contraction, incomes drop, which means the tax haul drops as well. If we think about GDP, and an identity for GDP is GDI, which is gross domestic income. Gross domestic product equals gross domestic income. And if we think about an average tax rate in the economy of, let's say, 28%, the higher GDI is, even at the same 28%, the higher tax revenue is. So an economic contraction would shrink GDI. Even with the same tax rate, you'd have lower tax revenue. Political uncertainty. Excessive debt service needs. Think of a country whose debt levels are 100% of GDP and 150% or 200% of GDP, and interest rates are high. Well, a lot of the tax revenue you collect has to go just to paying the interest. Expansionary economic policies. Expansionary economic policies would be good for GDP over here, which would raise tax revenues, but if you have expansionary economic policies, you're going to be running a budget deficit, more debt and more debt and more debt, right? Budget deficits, tax cuts. Well, if you have a tax cut, imagine GDI, instead of multiplying by 0.28 to get your tax revenue, you're multiplying it by 0.24. You actually have less revenue now. And limited ability to collect taxes. This is not so much for the sovereign, but once you get into agencies, government agencies, they don't have the ability to collect taxes. So I note illiquidity risk here, and this isn't just for sovereign or public entity. It is, this whole category is a source of illiquidity risk because we have asset sales. You have additional debt issuance, equity issuance. Here again, more debt issuance, sale of public assets. In times of market stress, it is sometimes difficult to come to market with an equity offering or a debt offering, and it becomes even more difficult to sell assets for their fair value. So illiquidity is the inability to raise funds. That we can contrast with insolvency, is a case where your assets are less than your liabilities. Okay, let's have a look at how we measure credit risk. And let's start with this diagram at the top of the screen here. Our first box is our expected exposure. The next one is the recovery rate. And if we multiply our expected exposure by 1 minus the recovery rate, if this is a recovery rate, let's say 20%, 1 minus 20%, 80% would be our loss rate. The expected exposure multiplied by the loss rate is the loss given default. Let's start with expected exposure. It is principal plus accrued interest. So let's take a 6% bond and you buy it for 100. At the end of the year, you're expecting 106, your principal back plus your interest. That is your expected exposure at that point in time. That sometimes confuses students because they say, well, I didn't put out 106, I only put out 100. Wouldn't my exposure only be what I put out? And the best way to answer that is to say, well, imagine you start working for me on a Monday. And we get to Friday, and I default and I don't pay you. The argument is, well, I don't owe you anything. You didn't put up anything. And your argument back is, but I worked a whole week for you. So in your mind, you're out a week's pay. If I agreed to pay you $1,000 a week, you're out $1,000. I owe you $1,000. Even though you haven't lost $1,000, you've earned that $1,000. Well, your money has earned that 6%. The same as you have earned that 1 week's pay, even though you didn't put anything out. So you put your money to work. Your money worked for a whole year. It has earned its paycheck. Your money's paycheck is the interest rate. So your expected exposure at any point in time is the principal plus any accrued interest. The recovery rate is, well, okay, let's say you default and I have access to assets as collateral. I can take the assets, sell them. How much can I recover? Because sometimes loans can be well collateralized or even over collateralized such that my recovery rate is 100%. And if it's 100%, what is the loss given default? Anything times 0 is 0. And if my loss given default is 0, no matter if it's 100% probability, look at the bottom here for expected loss. Loss given default times probability of default. Even if the probability of default is 100%, but my loss given default is 0, what is my credit spread going to be? Basically 0. I basically have a risk-free bond because it's so over-collateralized, right? If you are familiar with the notion of a pawn shop, that's a pawn shop. You'll take your $6,000 watch to a pawn shop because you need a loan. The pawn shop will give you a $1,000 loan. And if you come back in 30 days and pay back that loan with interest, you get your watch back. You're putting your watch up as collateral. If you don't come back, they keep the watch. Well, they know they can get $2,000 or $3,000 for your $6,000 watch. So even though your probability of default, at least most people who use a pawn shop, probably have no plans of coming back, even though the probability of default for most of the customers there is 100%. The loss given default is actually a gain. I'll take no loss on it because every loan I give is over collateralized. So the recovery rate, let's say the recovery rate is only 40%. That means 1 minus 40% is 60%. So you'd multiply your expected exposure by 60% because you're only losing 60% of the expected exposure. That would be your loss given default. Then you'd multiply that by the probability that it actually defaults, and that would be the expected loss, the probability weighted amount of loss. The probability of default is usually stated as an annual measure. Now, the loss given default is affected by the seniority of the claim and the value of the collateral. The lower in the capital stack you are, if you're junior debt or subordinated unsecured debt, your loss given default might be 100%. But if you're senior secured, your loss given default might only be 10% or 5%, assuming that you can probably recover most of your investment. When loss given default and probability of default are stated in percentage terms, we can come up with a very close approximation for the credit spread. It is approximately equal to the loss given default times the probability of default. So let's say that we are holding a bond and we calculate that our loss given a default would be 80% of the value of our exposure, 80%. The probability of default is 1%, so the credit spread would be 0.8% or 80 basis points. Probability of default is affected by profitability, coverage, and leverage. The lower the profitability of the issuer, the lower the coverage ratios. Coverage is how many times your cash flow can pay interest or how many times your cash flow can service the debt service coverage ratios, etc. And the higher the leverage, which means the lower the amount of equity you have financing your assets, the higher will be the probability of default. Some things that we can look at, the EBIT margin, that is our earnings before interest and taxes, or what's called our operating margin. The higher the operating margin, because it is before interest, right? We pay interest out of the operating, but the higher the operating margin, the less credit risky we are. The tighter your margins are, the more your margins get squeezed, well, then your coverage ratios start to drop, you become riskier. EBIT to interest expense, this is a coverage ratio. The higher the coverage ratio, the better off you are. Debt to EBITDA, this has a negative relationship. The higher the amount of debt you have as a percentage of your EBITDA, the lower the credit rating you would have. And cash flow to net debt, obviously the more cash flow you have to the net debt that you have, the higher the credit rating. So when we talk about net debt, all companies on their balance sheet have cash at all times, and then on the other side they have some level of debt. When we talk about net debt, we're taking the full amount of debt, both short-term and long-term, and subtracting out the cash that exists. Because every company, for working capital reasons, has cash and cash equivalents on their balance sheet. Well, net debt says, well, you already got some cash. So what is your cash flow? This is how much flows into the company over a period of time. Cash is a stock variable. Cash flow is a flow variable, right? Does your cash flow to net debt ratio, is that low or is it high? The lower the cash flow to net debt, the lower your credit rating. So you want a nice high relationship. That's positive. All of these are positive relationships except debt to EBITDA. Describe the uses of ratings from credit rating agencies and their limitations. As far as credit ratings are concerned, there are three major credit rating agencies in the U.S. Depending on what country you're in, there may be another dominant credit rating agency. Moody's, Standard & Poor's, and Fitch. And they provide credit ratings for issuers and issues. So company ABC will have a credit rating. And company ABC's bonds will also have a credit rating. And they monitor ongoing performance. For the credit rating, this is a bit of a problem here. Issuer pays. I say it's a bit of a problem because you have a potential conflict of interest. I need a rating on my bond to sell it, and I would like an investment grade rating to lower my interest expense. I'm going to contact one of these credit rating agencies and say, can you rate my bond? And I will pay you. How much does it cost? Well, you know, if they have a high yield rating when I want investment grade, yeah, you see the potential for a conflict of interest is, look, I'm paying the bill here. I'm the customer, aren't I? Credit ratings are letter-based, and they encapsulate both loss given default and probability of default. And if you have credit ratings and you have very little default risk, you still have some credit risk called credit migration risk. This is the risk of a downgrade. So you are rated AA or AA plus. I put a check mark there, so I'll go with that. You're rated AA plus, and you have a downgrade to a AA minus. Well, your credit spread is going to widen, which means if you then introduce new debt after that downgrade, it's going to have to go out at a higher cost. And if you're holding that AA plus bond and it gets downgraded 2 notches to AA minus, the credit spread will widen, the price of your bond will drop, you'll be sitting on unrealized losses. Even though you have no fear that that company is going to default, you still have credit risk in the credit rating because you have credit migration risk. Credit ratings are broken down into 2 groups. You have investment grade and you have non-investment grade, sometimes called junk or high yield, sometimes referred to as low grade or speculative grade. It's all the same thing. So AAA, the highest credit quality, lowest level of credit risk. Most sovereigns are AAA, at worst AA, which puts them here. Upper medium grade, this is A plus, high credit quality with a low level of credit risk, even going down to low medium grade, good credit quality with moderate level of credit risk. And if you get downgraded from the lowest category of investment grade to the highest category of high yield, it's not just a small drop, it's a huge drop in price because it is a large gap between the spreads between those two. And falling from investment grade to high grade, we've seen this before, these are called fallen angels. And they drop in price significantly because there are some funds that can only hold investment grade debt. So they may be holding BBB minus. If it does get downgraded to high yield, they have no choice. They must sell it. So we can see the highest level of non-investment grade. Look at the word speculative with substantial credit risk. So you go from moderate credit risk to substantial credit risk. Going down into the single B category, highly speculative with high credit risk. The triple C's, basically on bankruptcy's doorstep, but not there yet. Substantial credit risk with default a real possibility. And then when you get into the letter D, basically it is default. It is default. There you go. You can remember it. It's got the letter D. Okay, let's look at some limitations of credit ratings. And think about equity ratings for a moment. Even in a contraction, most stocks still have a buy rating. It's very rare that you have more sell ratings than buy ratings, even though in a contraction, everything is dropping in price. There are still more buy ratings than sell ratings. They are slow to adjust. Credit ratings are the same. Credit ratings tend to be sticky and lag market pricing of credit risk. So the market tends to be ahead of where the credit rating agencies are. So you may be looking at a AA bond, and it is being priced with BB credit spreads. And you think, I think I found a market mispricing. And probably not. It's probably that the market is anticipating a ratings downgrade that the rating agency hasn't gotten to yet. Beyond just a rating, the rating agencies also have a rating outlook. So let's say that you have a bond that is BB. There may be an outlook that is positive or an outlook that is negative. So it might be BB negative or BB positive. Positive means things are looking good for this. It's not ready for the upgrade, but it's certainly moving in that direction. Negative is things are looking bad. It's not ready for the downgrade, but it's moving in that direction. The ratings outlook is more timely with market conditions. The rating change does lag. Some risks are difficult to capture in credit ratings, things like ongoing litigation, environmental risk, or natural disasters, because, well, some of these have binary outcomes, especially litigation. You could win or you can lose. Environmental risk may not become obvious until much later. Say in natural disasters, while they are random to begin with, may result in split ratings. Some rating agencies may place a higher probability on adverse litigation, while other rating agencies may say, no, we think it's a 50-50, and somebody may say, oh no, the company has no issue on this one. So different ratings by the three agencies, that's what split ratings are. Then it becomes difficult to assess what's going on. You have a company with three different credit ratings or an issue with three different credit ratings, and you think, well, which one is right? Ratings may involve miscalculation or unforeseen changes not fully captured in a rating agency's forward-looking analysis. In other words, these are done by humans, and humans are prone to error, which means that you really shouldn't just rely on credit ratings, but you should conduct your own credit analysis. Describe macroeconomic, market, and issuer-specific factors that influence the level and volatility of yield spreads. Okay, for factors affecting the yield spread, we have to define another term here, credit spread risk. That is the risk of greater expected loss due to changes in credit conditions. So we're going to look at factors that would change credit conditions. Let's begin with macro factors. And we need to understand how the spread correlates with the business cycle. That correlation is negative. In expansions, spreads contract, and in contractions, economic contractions, spreads will widen. They tend to be their narrowest at the peak of a cycle, and they tend to be their widest at the bottom of a cycle. And this is its correlation with, you can call it the business cycle or the credit cycle. Reason I've mentioned before, as the economy expands and cash flows improve, profitability improves, it lowers credit risk, but it also induces inflationary pressures, which raises the risk-free rate. So rates are rising, or the curve is moving upwards while spreads are contracting. And then as the economy is turning down, even though interest rates are dropping, which is supportive of bond prices, the credit spread here is widening. So with this, if we're bond investors, why do we want to take on any kind of risk that falls outside of interest rate risk? Why even take on credit risk to begin with? Why not stick with investment grade debt, which has some credit risk, but they're not going to default on us? Why even take on bonds that have the potential of default? Because if we do have an economic contraction and credit spreads widen, on high yield they widen a lot, and the default rates increase in the high yield category. Why not just avoid that? The addition of credit risk to a portfolio, and when we say credit risk, primarily high yield, does provide portfolio diversification in a bond portfolio. Because the higher spread product will have a lower correlation with the investment grade products in your portfolio. You can, in a bond portfolio, in an expansion using high yield, introduce equity-like returns. Because again, let's draw out a high yield spread. There is the risk-free component. Here is the credit spread component. As the economy is improving, you're going to have a situation where the risk-free rate rises. So there is an increase in the risk-free rate from where it was, but the credit spread will shrink, which means the yield lowers, the price increases. So it does behave like an equity across the business cycle. It increases in price as the market gets better. It decreases in price as the market gets worse. Government bonds are the opposite. They decrease in price as rates go up, and they increase in price as rates go down. So in a bond portfolio, high yield is a good diversifier. In an equity portfolio, not as good a diversifier as investment grade or government bonds because they are equity-like. Lower correlation with investment grade and sovereign yields. It also provides capital appreciation because you get equity-like performance over the business cycle. And you get those equity-like returns with lower volatility. Okay, some other factors affecting the spread. The credit rating. The higher the credit rating, the lower the required yield, which means the lower the credit spread. The longer the maturity, the higher the required yield. You have a maturity premium in there, which means you should have an upward sloping credit spread curve within each credit rating. This one requires a little bit of explanation. The investment grade OAS, the option adjusted spread, which is a measure of credit risk, is less than the difference between the high yield and the investment grade spread. So let's just take an investment grade as a category, and let's say spreads are 150 basis points. But let's say on high yield they're 450 basis points. So 450 minus 100 is 300 basis points separating high yield from investment grade, which is greater than just the credit spread on investment grade alone. So there is a big gulf between investment grade and high yield in terms of what you're getting paid to take on that incremental credit risk. Let's look at credit curves over the business cycle. And these are just credit curves. These are just the spreads. Never mind about the interest rate component. It's just the spread. For investment grade, no matter what part of the cycle we're in, it's typically upward sloping. Look at late expansion, the dotted line here, upward sloping. If you look down under peak, it's still upward sloping. Investment over into contraction, upward sloping, and in early expansion. And it's usually below high yield spreads. Let's start with the peak. Remember, I said earlier that the peak is associated with the narrowest spreads, and you can see how low those spreads are at this end of the curve. What's going on here? We're at the peak of the curve. The market is going to start anticipating a contraction. So near-term debt, debt that's due in 6 months or 1 year, maybe even a year and a half, might still have low spreads. But once you go out to 3 years, 5 years, 7 years, there might be some concern about the company even making it through the contraction. So credit spreads will widen at longer maturities, and you'll get that kind of curve, much more steeper curve at the peak. The peak falls into contraction. What happens is credit spreads widen. Now look what happens to investment grade. Look what happens to high yield. Notice that high yield is inverted. This reflects near-term credit market tightness, which is, I put that in blue, which is a terrible color to underline there. Now we'll use the blue. So what it's saying is that if you have debt, sorry, down here in the contraction, if you have debt maturing in the next 6 months, 1 year, 2 years, we can see that a company would probably have a difficult time because you're in a contraction. It might be hard to roll over your debt. But if they can survive past a certain point, things are going to get better, which is why at longer maturities you end up actually having lower yields. Early expansion, things start to get better, so they've dropped. Credit spreads have dropped a little bit along the whole curve. You still have a slight inversion in high yield because there's still some concern whether you can make it through the lean years of an early expansion to continue to survive into the expansion phase. Once you're in the expansion phase, okay, things are great. Credit spreads drop, and you will have upward sloping curves on both of them. Low spreads, upward sloping, because the longer the maturity, well, the more risk there is. And then once you get to the peak again, it compresses even more. But we're back to, hang on a second though, they might not be able to survive the contraction. So this is anticipating credit cycle contraction, and around we go. Okay, some market factors affecting yield spread. Credit, tax, and liquidity. We're not going to deal too much with tax issues because that is particular to each jurisdiction you're in. I think we have an idea of the credit issues that affect the spread. Let's look at liquidity. Wider spreads for more illiquid bonds. So we can look at the issuer size and the credit quality. Some issuers don't have a lot of debt outstanding, maybe 1 or 2 bond issues. They might be for $300 million or $500 million each, really, really small. So there's not a big enough market for a lot of liquidity in those bonds. And the lower the credit quality, the wider the spread as well. So lower the issuer size, the lower the credit quality, the wider the spread. Also, when financial conditions become stressed, all spreads widen as well. Issuer-specific factors that affect the yield spread. The big one here is the issuer financial performance. And we can assess that with coverage ratios and leverage levels. Coverage ratios, I've just put it in terms of cash flow per year divided by obligations per year. So your cash flow could be EBITDA, could be EBIT, could be cash flow from operations. Your denominator could be just interest payments for the year, or it could be a debt service coverage ratio, for example, where it's interest payments, principal payments, plus lease payments for the year. Assessment of relative spreads. Compare an issuer with similar industry and credit quality comparables to determine or try to assess how much of the credit spread might be issuer specific. Here's an example. Let's say industry B or industry A, if we look at all the companies in industry A, have on average a triple B rating. The average OAS for that industry, the average credit spread is about 220 basis points. We see company XYZ with an OAS of 300 basis points. So we would say, well, there's an estimated 80 basis points that is issuer specific, or it could be, if you drop the R, issue specific. There might be something with that particular bond itself that requires a higher spread. And finally, let's look at the price impact of a change in spreads. The yield, as we've seen before, is made up of two components, a risk-free component and a spread. So a change in yield, a change in spread will result in a change in yield. And we've already seen how we calculate the change in the bond price for a change in yield. It's the same thing, except we just substitute it with just the spread. We just say the spread is changing by 20 basis points. Well, then the yield is changing by 20 basis points. Same thing. For investment grade bonds, we are more concerned with spread risk versus default risk for high yield. And spread risk is a change in price due to a change in spread or a change in credit rating. If you have a change in credit rating, you will get a change in spread. The percentage change of the full price of the bond is negative your duration statistic times your change in spread. And we've seen that this could also be yield. And we've seen it also with curve. It's the same thing, except we just change what is changing. Here, just the spread is changing. When we calculate a modified duration for a change in yield, the change in yield could happen because spot rates are changing or because credit spreads are changing. Here, it's just the credit spread. And then we add our convexity factor, which is 1/2. There's our convexity statistic times the change in spread squared. But we're just using the modified duration of the bond. Now this works for fixed rate, I'll write it down, fixed rate coupon bonds. Okay? It does not work for floating rate bonds. Because remember, floating rate bonds have a very low sensitivity to changes in interest rates. However, a floating rate bond is credit risky its whole life. So the spread duration of a floating rate bond will be what it would be if it were a fixed rate bond. However, the modified duration or the effective duration of a floating rate bond is very, very low because the coupon resets to the interest rate plus a spread. So as long as the spread doesn't change, you've got very little price risk. But if the spread changes, well, it doesn't reset at each coupon date. It stays changed for the entire life of the bond.